Welcome back. In this episode, we're going to talk about the future of AI, what's happening, where I personally think the opportunities are, which companies are best positioned to benefit, and what I'll personally be doing with my portfolio. As you may know, I have this watch list called Top Quality here, which includes what I believe to be some of the best companies in the world. These are large, dominant companies with wide moats and great earnings and pricing power, meaning they should be able to raise prices, perform better than the market, and compound, providing greater returns over a long period of time when compared to the S&P 500. Ultimately, when I think long term, these are the types of companies I want to own. However, since I started this portfolio and since I refined my investing strategy to pretty much prioritize these companies, a lot of them have simply been too expensive, and I've bought lower valuation companies in the meantime. If we look at my portfolio here, you'll notice that I currently don't own a lot of these top quality companies. The companies that I do own is Amazon, ASML, and Google. As I said, a lot of them have been trading at very elevated valuations until recently when Salesforce traded down to near the lowest positive PE ratio we've ever seen for that company. And because of that, it's about to become the fourth company on my top quality watch list that I add to my personal portfolio. Before we move on to the opportunity I'm seeing there, and the first AI topic of this video, I want to address a few other positions in my portfolio, specifically PayPal, Celsius, and GXO. I bought PayPal in October 2023. For a while, it was outperforming the market nicely as I expected it to, but then at the start of this year, it really took a tumble and is now underperforming when compared to the S&P 500. I think the company is still severely undervalued, and I want a lot of value for my money when I buy stocks, and that's what PayPal gave me. And I think it will be a great investment as Alex Chris slowly turns the company around. And I mean, the company literally has a share buyback authorization close to $20 billion when the company is only worth around $70 billion. So there's a huge buyer in the market, and while it isn't the most exciting business at this point, it's still a steady grower, and I don't think a 14 forward P is fair for the company. I think it should trade near the overall market valuation. That being said though, when I see Amazon, Salesforce, Google, and ASML all underperforming the market and reaching the lowest valuations we've ever seen for those companies, while the underlying businesses have all gotten stronger in my opinion and are just at the start of the next growth cycle, I feel like I just have to part ways with a company like PayPal, stick with my strategy and use these opportunities I'm getting with, the market discounting these types of stocks. And I do believe more in these four companies on the screen right now than PayPal long term. I mean, I do truly believe that right now we are going through the investment opportunity of a lifetime, and these companies are all going to play a huge part in it. Next up, Celsius. Again, this is a company I was buying while everything else seemed too expensive, essentially. I bought my first few shares back in October 2024, then, bought heavily during this dip here in December and in February. I actually tripled my position during those two declines. Since then, the stock has outperformed the market and I'm up around 50% on it at this point. But the valuation is starting to rise again on this one. It's sitting around a 46 forward PE. If we look at the revenue chart though, we can see why this company in the past and is currently valued highly. The growth has been insane, and I do believe in Celsius in the medium term. They have the marketing strategy on lock, and they're able to market their product as a healthy energy drink option to more of the lifestyle and fitness market segments. And they've been able to capture the female audience with their products, which no other energy drink company has been able to do. So that's why I believe in this company in the medium term. If we think long term, though, I simply don't think this business model or product is as strong as some of the tech and AI companies I'm interested in. Anyone can make a flavored sparkling drink, and the moat just isn't very strong with Celsius, in my opinion. But who can go out and make a product to compete with YouTube? Who can build cloud provider infrastructure? Who can get over 3 billion people to use their platforms daily like Meta? Who can build lithography machines like ASML? All of those things are really hard to do, if not impossible at this point. So I feel like I just have to part ways with Celsius at this point, now that some of those valuations on my top quality companies have come down. I do think Celsius was a good investment in the meantime though, and I'm really happy with the gains. With GXO, I do think that it will be a great beneficiary of AI and robotics, but I guess I'm deciding to invest in the companies that I believe will win regardless of what end product becomes popular. The companies that will provide resources and services to the masses and benefit from the overall AI boom. And like Google and Amazon specifically, they have so many different massive businesses that will benefit from the implementation of AI in both an efficiency and productivity sense. But anyway, now that I've talked about those three positions and the fact that I'll most likely be selling them, we can get to the first AI point of the video and the companies I think are best positioned to benefit from this technology. And that first AI point I want to bring up is Agentic AI. Agentic AI has been called the next step in AI or the next wave of AI technology, and it's being called that by the godfather of AI, Jensen Huang, NVIDIA CEO. To explain what this technology is, essentially, Agentic AI means giving AI the ability to think, plan, and take action on its own to achieve a goal. And the best positioned companies, in my opinion, are Salesforce with Agentforce and Google with AgentSpace. Now, I think Microsoft is also up there with their solution, but their stock just isn't nearly as attractive on a valuation basis as these two companies. Starting with Salesforce, they've already captured a huge share of the market. Many of the most powerful companies in the world already run critical parts of their business through Salesforce, collecting and acting on customer data every single day. That's what gives Salesforce a real head start. Their Agentforce solution integrates directly into the platform these businesses already use. And since Salesforce is embedded into their daily workflow, it's the natural place to deploy AI agents. These agents could handle everything from sales outreach, chat and email engagement, Slack responses, answering client and support questions, updating records, scheduling meetings, managing inventory, visualizing data, and even training and coaching employees. And the more data these companies feed into Salesforce, the more powerful and context aware these agents become. That's a huge incentive now to use Salesforce even more and collect even more data within it. But overall, I see Salesforce capturing a lot of the business side of this AI opportunity. And Salesforce has recently been trading down towards the lowest positive PE ratio we've ever seen for the company, a forward PE of 23. And if we look at the PE ratio, the trailing PE ratio historically, what we're sitting at right now, around 41, 40-ish, is pretty much the lowest we've seen in the past 5 years, even in the past 10 years. If we go and look at, the lowest positive PE ratio the company's been at. And as I said, I think this is the opportunity of a lifetime, and we're just at the start of it, and companies are trading at the lowest valuations ever. I personally think investors are going to regret this. Now, looking at Google, they're in a unique position because they control both the infrastructure and the workspace tools where businesses operate pretty much every single day. Their cloud platform, Google Cloud, isn't just where data is stored anymore. It's where AI can actually live and work. That gives Google a massive advantage when it comes to deploying agentic AI. Imagine having AI agents that not only have access to your documents and your emails and your spreadsheets in Google Workspace, but can also write code, spin up infrastructure, query databases, automate reports, and even build internal tools, all within Google Cloud. And on top of that, Google already has one of the most advanced AI models in Gemini, and now they're embedding it across Gmail, Docs, Sheets, and even their developer tools. That means an AI agent could read a customer email in Gmail, check your sales data in BigQuery, draft a response, update your CRM, and send a calendar invite, all without you lifting a finger. And because it's all within Google's ecosystem, the integration is smooth, fast, and secure. And that's why I think Google is also really well positioned for this opportunity. And they're only trading at an 18 forward PE. Google's revenue growth is still in the double digits, despite their massive size. And the way they'll likely be able to continue to aggregate demand into their ecosystem, I don't see that slowing down. Think about how many services they can eliminate with AI agents over time. And just think about the scalability of this technology and how little it will cost Google to meet demand when compared to, multiple human employees doing those same jobs. But okay, let's move on to the next topic. Cloud has obviously been one of the best, strongest, and highest margin businesses to get into over the last decade. But I think this business is about to go to the next level. Goldman Sachs estimates that the cloud computing market could reach $2 trillion in revenue by 2030. This visual here isn't from them because, they didn't provide a nice one, but that would represent somewhere around a 20% compound annual growth rate for this industry. And this will largely be driven by the increased need and demand for compute by AI. running queries for large language models, AI agents, and so on. I already spoke about Google in this video, so I want to focus in on Amazon in this section and talk about, their financial metrics and the company as, overall an investment opportunity. Obviously, Microsoft is also a huge player in this market, but they're simply not as attractively priced as Google and Amazon at this point. Okay, Amazon currently has a forward PE of 33. This is one of the lowest valuations we've ever seen for Amazon, by the way. With Amazon, though, it's important to understand that investors are constantly playing this game of trying to figure out or estimate just how profitable Amazon is. Because if we look at the free cash flow chart today, it looks like their business isn't even that profitable. Last quarter, they generated $20 billion of free cash flow and that's on a trailing 12-month basis. That's compared to $70 billion for Microsoft and Google. Now, CapEx is directly affecting how much free cash flow they report. Instead of being a massively profitable company, Amazon consistently reinvests in data centers and logistics and planes and vans, fulfillment centers, chips and AI, recently healthcare, drones, autonomous vehicles, let's like Prime Video, and the list goes on. But for example, in the last quarter, they spent $25 billion on capex. If they didn't spend that much on capex, their free cash flow for the quarter would go from uh, on a quarterly basis, it was negative 8 billion to upwards of 17 billion in a single quarter, or almost 70 billion for the year. And then we have other expenses that indirectly affect free cash flow and could, add more if they controlled those expenses more. So, if and when Amazon wants to turn on that profit machine and start returning dividends and value to shareholders through buybacks, the money and value being returned will be insane, I think. But anyway, Amazon's AWS operating margins show how good of a business cloud can be. And Amazon is also a more direct AI play because all of their other massive businesses, as I mentioned earlier, AI will be able to increase the efficiency and the cost efficiency of the e-commerce business, through logics and delivery. Also, the grocery stores, it'll be able to improve advertising, drones, autonomous vehicles, customer service, AWS, autonomous robots, and their warehouses down the line, and so on. And the amount of money and time they'll be able to save with that cheaper labor will be absolutely insane. But okay, it's time to move on to the next section of this video, and it's yet another angle you can play this AI opportunity from. So, what runs all of this technology? What is Amazon, Google, Microsoft, Meta, Tesla, and all of these companies spending tens of billions of dollars on every quarter? Chips and data centers. So, I have two companies from this side that I invest in, AMD and ASML. You might ask, why not NVIDIA? And before I answer that question, let me be clear. None of what I'm about to say means that I think NVIDIA isn't going to be a good investment over the next years and decades. But at this point, NVIDIA has already made its move. You may say that the company isn't even overvalued, but I don't think it's as easy as looking at the PE ratios with this one. If you look at the gross and profit margins for that company, they've been extremely high because they had no other competitors, so they've essentially been able to charge whatever they want for their products. However, now that companies are making their own chips and AMD keeps coming out with better and better chips, they'll have competition. And some of the Mag 7 companies at this point are already doing business with AMD. And as their chips get better, they could put some pressure on NVIDIA and their margins, especially since AMD's chips have been seen as potentially better for inference workloads. So if NVIDIA's margins drop, their earnings won't be as impressive as analysts, are expecting, and then in reality, the forward Ps may not be as low as they appear to be today. And NVIDIA's growth rates are currently slowing down, while AMD's are essentially just starting to accelerate at this point. So that's why I'm choosing AMD. Their overall revenues and data center revenues are really starting to explode, and they'll likely be going through a cycle of margins expanding. And they've been kicked to the side by the market, and the valuation on that company right now for the growth rates that they're putting up and are about to start putting up is simply too low. Now, the other company I invest in from the semiconductor side is ASML. I describe this investment as investing in a business that sells shovels during a gold rush. It doesn't matter who wins in the end, ASML will win too. They're a huge part of the semiconductor manufacturing process, specifically the patterning segment of that process. They hold close to an 80% market share in this segment that is crucial for the continued innovation of chips, and there's simply no other company in the world that comes close to their technology. So essentially, a large majority of chips that are created pass through ASML machines at some point, and they sell those machines for hundreds of millions of dollars. So their moat is absolutely massive because they're years ahead of the competition, and all of that during a time when semiconductor demand is going through the roof. However, they're trading close to the lowest valuation we've seen on the company in the past 10 years. Okay, now I've talked about most of my big AI investments. Let's switch gears and talk about the technology and the products and services that are coming from AI. First off, we have Waymo absolutely taking off in the ride sharing category. In April, they announced that they're completing 250,000 paid trips per week. That's more than 2xing from 2 quarters ago and 5xing from 3 quarters ago. And they're planning on expanding into Atlanta, Miami, and Washington, D.C. in 2026. This technology allows them to operate these vehicles 24/7 with very limited downtime and without the driver taking a significant cut of the ride. I personally think they're doing the right thing by partnering with Uber to get access to the massive network of users, and that's how I believe they're, scaling so quickly already. Next up, we got the news that Meta aims to fully automate advertising with AI by 2026. This article says that Meta Platforms aims to allow brands to fully create and target advertisements with its artificial intelligence tools by the end of next year, the Wall Street Journal reported on Monday, citing people familiar with the matter. The social media company's apps have 3.43 billion unique active users globally, and its AI driven tools help create personalized ad variations, image backgrounds, and automated adjustments to video ads, making it lucrative for advertisers. A brand could provide a product image and a budget, and Meta's AI would generate the ad, including image, video, and text, and then determine user targeting on both Instagram and Facebook with budget suggestions, the report said. Meta also plans to let advertisers personalize ads using AI so that users see different versions of the same ad in real time, based on factors such as geolocation, according to the report. This should show us that AI will be used to improve pretty much everything in our world. If this technology can just marginally improve customer click through rates for a company spending billions on advertising by making ads, even more relevant to the end user, that could result in tens of millions of dollars in sales. And not having to pay a production crew, a videographer, and people to edit it and all that, they're going to save tons of money that way too. And then we can look at some of the other categories. We have drones for both delivery and national security. Then we have humanoid robots for, the hard labor that humans won't need to do anymore. Humanoid robots obviously don't need to sleep, they don't have a salary, and you're not liable if it gets hurt. Then we have drug discovery and the healthcare side of this, and obviously the list goes on here too. So, to bring it all back, where do I see the biggest opportunities? In the companies that supply the resources and provide the platforms. And as I mentioned before, I think these companies will continue to aggregate demand into their existing platforms and services, not just from US consumers, but from consumers around the world. These companies have been the best companies in the world over the last 10 years. People have bet against them and said that their valuations aren't sustainable, but we've simply never seen companies like this before. And I think they're just getting started. And also, I feel more comfortable predicting the success of these companies than trying to figure out which end product will make the most money. And ultimately, I think I'll be able to hold these companies for longer. A lot of products and services out there in the future will win, but I think these companies will get a slice of that win in the process. And I'll say it again, I think we're just at the start of the AI boom here, and I'm not going to miss it. But that'll be it for this video. Let me know what you think about my investments and my overall thinking here in the comments below. See you in the next one.